All right, joining us now for a closer look at the bond market reaction, R.J. Gallo, Federated Hermes Senior Portfolio Manager. Good to see you, sir. Let's first get your reaction. We knew the 75 was coming. Anything inside the language surprise you, in particular the mention of the lags with which monetary policy affects economic activity and inflation?
Well, I think you and all the prior guests who just spoke before me are focusing on the right things. That the addition of that language elevated the importance of the idea that when you get closer and closer to a destination, you slow down, just like when you're driving a car. And that's what they're telling us. The acknowledgement of the lags, the cumulative tightening that's in the pipeline, the signal is clear. They're getting closer to their pause. It'll probably be early to mid 2023, call it 475 or 5. And then they have to stop and wait to see the cumulative impact of the tightening. The fact that the bond market is reacting with the steepening, where 2- and 5-year yields are double digits richer, makes some sense. This new language, I think, forecloses, at least for now, the concern that they're going to keep going 75. And I think it affirms expectations that were built off of recent FOMC members' speeches and appearances that this day was coming, this idea of slowing the pace and getting closer to the pause.
But RJ, when we're getting closer to a destination, I'm looking down at my GPS and I'm seeing the time go down 10 minutes or so. We're not seeing that in inflation. We're still at a 40-year high. What evidence is there that we are closer to the destination, which is 2%?
I'm going to stay with the car analogy.
Okay.
If you are going to drive your car by looking solely in your rearview mirror, you will hit a wall or another car. That's what the Fed would be doing if they looked solely at CPI and PCE, realized past inflation, while driving the car of monetary policy as the economy moves forward. They need to look forward and anticipate. It's undeniably clear that monetary policy is not instantaneous. Mortgage rates have surged, but other interest rate sensitive sectors are only now starting to feel the pain, the cumulative impact of a sharp and aggressive tightening that is already underway. They need to look through the windshield as to where the car is going. Lags take time to overcome. We cannot set policy solely on realized past inflation. The Fed is heartened, by the way, by the fact that inflation expectations are all pretty much south of 3%, whether you look at tips or you look at surveys. So they are acting in a manner that keeps those expectations relatively contained, and they can't set policy solely on realized inflation. It's like driving a car looking solely in the rearview mirror.
So, Arjun, in terms of what we saw with Q3 real GDP, obviously we know that the Fed is data dependent, but with so many different indicators pointing in different directions here, what does this mean for not just the likelihood of a recession, but how deep of a recession we might be headed for?
Q3 GDP was an upside surprise propelled heavily by the surge in exports and the drop in imports. The post-pandemic world has been dominated by heterogeneous reopenings, all kinds of distortions to global trade patterns. Who actually thinks exports are going to keep growing at a double-digit rate? Very few people. The economy is slowing in China. The economy is likely going to be in a recession in Europe. Global growth is slowing. Our exports are not going to continue to expand that pace. If you X out the impact of trade and government spending from the Q3 GDP release we just had, it was 0.1% at a seasonally adjusted annual rate. 0.1. That wasn't that strong of a GDP print. The underlying internals, when you X out trade in particular, as well as government spending, are weaker. The midterms are coming up. Government spending is not going to be surprising to the upside when we have divided government with Republicans controlling perhaps the House and the Senate, certainly the House.
RJ, certainly when you take a look at the market's reaction, they're not waiting for the press conference just in terms of how they are interpreting this additional sentence that was put into the statement. But when we look ahead to that press conference from Fed Chair Jay Powell, what are you hoping to hear? What will you be listening for over the next 45 minutes or so?
The new language that we've all been talking about is going to get questions from the media that's assembled in the room there. They're going to want to drill down for further meaning there. It's a challenge that Chairman Powell faces getting in front of them at any session, but he actually has a unique challenge now. This language, which I think was unanimous across all the voters, suggests that they're opening the door to the pause. It's not right away, but we're getting close. We're getting close to our destination, as I said before. There's going to be a lot of questions about how the market should interpret that new language. Why was it put in there? Clearly, the committee, on a unanimous basis, feels like it belongs there. Can Chairman Powell still sound hawkish on inflation while acknowledging the need for a pause and not open the door to a huge rally? Former President Lockhart mentioned it earlier. It's a tough act. It's not an easy task to communicate such subtleties to the markets, which often trade on sound bites. So there's the risk that he gets up there and tries to talk back or walk back the language in the statement. That seems like a low risk. I think he may elaborate on it in a way that will get further bullish response from potentially equities and from the intermediate part of the Treasury curve, for example.
So then, RJ, on behalf of investors, if you were in that room with Jay Powell, what would you want to ask him?
Interestingly enough, I think that the bigger questions come down to quantitative tightening, the Fed's plans with respect to the balance sheet. They've made their pace of balance sheet reduction abundantly clear, but there's plenty of talk, including talk at the Treasury Department, of the need to sort of bolster liquidity. Bond volatility, both implied and realized volatility, has been extraordinarily high this year, and liquidity conditions have likely something to do with that. I'd be interested to see what Fed staff at the Federal Reserve Bank of New York, working with the Treasury, what they're thinking about, what measures could be taken to allow the balance sheet to shrink, to be consistent with the overall monetary tightening, but to do so in a way that might be less disruptive to the functioning of the marketplace.
RJ Gallo, always great to have you. Federated Hermes, a senior portfolio manager. Thanks so much.